Good afternoon, everyone. My name is Art Alvarez with MortgageWorks, where we have the answers, and they're on the house, coming to you from Palm Springs in the greater Coachella Valley area. And yes, this is really me. And I say that only because, as you may know, if you watch the show on a regular basis, our last couple of weeks, we had my avatar providing you relevant information about what's going on in the mortgage market and the bond market and so forth, and home ownership in general, and how to finance home purchases and all things residential mortgage related. So, but today you've got me back live, so I'm sure you missed me, and so I'm glad to be back. I felt like it's time to show my real face, and even though the avatar does a pretty darn good job, and that's just really an example, by the way, folks, of where we are, myself, Jeff, who works with us on the show, we're using a lot in the way of AI to try to improve overall what we're doing here on the show. And, this is an example when we use the avatar, how that can be very helpful to get our message out there. So with that, again, I'm glad to be back. Thank you for watching and listening today. And I'm going to go ahead and bring Jeff in right away so we can get into what we're going to talk about today.
Hey, Art, good to see the real you. Although, the other one is so easy to manipulate. No, I'm just kidding.
Well, I know, and plus the fact I like how it makes me look nice and slim. So
I love that. Hey, it would be remiss if I didn't start out asking you about we're going to change the format just a little bit here, but just showing just a couple things real quick. I just want to show it. This is my favorite because there is a little dip here, but it opens up a conversation that there's this little dip around the late Wednesday, early Thursday, but then we saw that kind of jump up quite a bit. Let's talk about that. What's causing this activity? Because the market has taken a bit of a cleaning today again.
Yeah, see, what's going on is, I've talked in the past how we can get into these periods of what I would call, bounded volatility. Early in the year, that range was pretty low. We were in the 4s to 415, 420. Then that kind of inched up as the Iran war started. And then we were kind of bouncing between 435 and 450 and kind of holding there for a while. And now, of course, we've broken through 450. And now for the last 2 to 3 weeks at least, been trapped in a higher range, more in the 460 to 470 range. And, this week, the economic data was pretty light, not a whole lot that would have the kind of effect that you're seeing on this chart today. But, things shift in terms of what the market and the bond market in particular is focused on. And right now, it's pretty much deemed, at least as to the bond market, they would look at the traders. The traders are looking at the employment. The employment part of our economy is looking pretty good, pretty stable. But now inflation is really a chronic concern, and it's gotten a little bit more of a concern because of the latest headlines about the fact that we've now hit $40 trillion of U.S. debt. And, the concern is rather logical. I mean, when you have that much debt, it provides a risk of having more inflation, not less. Plus the fact that the Federal Open Market Committee minutes were released this week, and they revealed that there was a lot of pretty aggressive debate about whether the Fed should have held rates steady this last meeting, or actually raised the Fed funds rate 0.25%. Wow. So that, plus seeing this kind of deficit number, or this kind of debt number that the U.S. Government has, that spooked the bond traders, and now they're back to worrying and hand-wringing about inflation. And of course, that's why we're now back to that 470 level.
Well, another key point that caught my attention too was consumer spending. And Walmart came out with a number, and their stock dropped quite a bit when they announced, hey, they kind of felt that going forward it was going to be a little soft. And in a way, I'm trying to spin this in the right way that, we've talked about in the past about, I can't afford a home, yet the affordability index is so strong, is really good. And yet there are people who are spending because they're getting lattes and this, that, and the other, and deciding to go on trips instead of saving for a house. could this be the turn of maybe the consumer saying, hey, you know what? I don't need more stuff. I'd really like to have a home, and I am going to start cutting back. Or is it the fact that, we as an economy and Amazon, they put out their sale, early, and, the whole thing with the soccer and the World Cup. Did that have any play into this?
I'm not so sure about the Amazon part, and I'd like to believe that to the extent there's any kind of softening in, like retail sales numbers and consumer spending in general, I'd like to believe that is an example of households reallocating their income, their cash, hopefully toward maybe house, and not get out there and just buy stuff for the sake of buying stuff. Because the related problem with that is a lot of those expenditures, a lot of that consumer spending ends up getting basically fueled by credit card spending, which of course can then therefore be a detriment to being able to qualify for a mortgage just based on calculating your debt ratio. So yeah, you'd like to believe that the cutback or the softening, I'm not sure there's been a major cutback in consumer spending, is at least an example of folks trying to kind of reorganize their balance sheet, if you will, and prepare for something, a bigger decision in their life, which of course is to buy a home. Now, on the other hand, there's some evidence that, real wage growth is getting a little bit slim, because that inflation number is, while a lot better than 3 or 4 years ago, is still a little bit too high over the Fed target. And maybe folks are just finally kind of caving into the fact that things are getting too expensive and cutting back just for the sake of cutting back.
Yeah, it's an interesting thing, and I know that you've been doing this for a long time, and you kind of are able to, and I mean this with ultra respect, is you're able to read the tea leaves where the rest of us, like, hey, we were just talking about this with a friend yesterday, former business partner, and there's a generation out here that has never seen anything except an upside, and so there's really not a lot of references out there. But people who have, gray hair, or in this case, no hair, maybe we see it differently. What are you seeing in the tea leaves?
Well, I think you have a good point there. I mean, in terms of the general population's view of things, it's always going to be somewhat generational. I mean, you have a generation that comes up every 20 years or so, right? And of course, they don't have the perspective, the recollections of how things were before they were even around. And so you can only kind of make decisions and draw conclusions on what you've, experienced, once you're, living and, growing up and becoming an adult and so forth. And so, yeah, the benefit us older folks have is we can see, we have a grasp more of the history of these kind of things and realize that most of this stuff goes in cycles. And for the current generation, I know they complain a lot about how, my gosh, I can't afford stuff. But yet there's some evidence with some of the economic data that just says, well, they're forging through pretty well anyway and spending money and spending a lot on borrowed money like credit cards. And so that's why I have said more than once, and I'll say again, home ownership is not as out of reach to people as a lot of them think. It really requires, sitting down, looking at the numbers, having a conversation, and determining what are they doing now? What are households doing now in terms of how they spend their money, and what could they be doing going forward to position themselves better without necessarily, sacrificing their living standard or what they want to do in life from, day to day, week to week, month to month. Somebody like us, like me, I can help them wade through all that and make the adjustments to their household, cash flow, their balance sheet, to get them in a good position to buy.
Well, I want to shift now to a different sector of the market, and these are the senior homeowners. And I kind of want to build a scenario for you. Imagine, you're 68, 70, 72, maybe even 75, and you have a home that's worth, $800,000 to $1 million or more, and you've been living there for a long time. You got a lot of equity, but now you still have a monthly payment of about $3,500 a month. but it's no longer coming from your salary. It's now coming from your retirement, and it's starting to make life a little challenging. Mm-hmm. What kind of options are out there for these people that maybe they hadn't thought of that could help reduce the strain on their day-to-day without saying, hey, Marianne, we got to sell the house because we can't afford to live here anymore?
Well, you bring up a good point, and something that we see relatively often that a lot of folks, our viewers, might be surprised at, because when you think about it, and I actually got an inquiry along these lines just earlier this week regarding a potential use of a reverse mortgage. And what you just described in terms of these parameters, and what I'm seeing with this particular inquiry that I have now, is we have situations where we have senior homeowners who own a home, have a lot of equity, and yet they have a loan balance that you might argue is a little bit surprising given their age. So, once you get into late 60s, early mid 70s or beyond, if you've owned a home, and if you've owned it for any length of period at all, chances are you are going to have a pretty good amount of equity, if not already achieved a free and clear status with no mortgage at all. Or if you still have a mortgage, it's probably at this point pretty modest in size and pretty easy to handle financially. However, there are, a pretty good number of senior homeowners out there who don't quite fit those parameters. Yeah, they've got a lot of equity. Yes, they've got a home that may be worth a good amount of money. Sure, 100, 800, a million, million one. In the case of the deal I'm working on, estimated value is $1.1 million. And the owner is 74 years old. And it's a single person, a woman, but she's got a $371,000 mortgage, costing her about $3,000 a month. And she's on a fixed income. So when you hear all that, you're saying, well, wait a minute. With most folks, fixed incomes could often be in the $3,000 level. So then you kind of realize that, man, this particular homeowner is probably having a hard time because their housing expense is using up all of their fixed income. And that can be a real problem.
Yeah, and in a situation like that, as you start to describe this, it's like it's a chilling feeling hearing that, because I'm thinking, I play pickleball with a lot of people that are in that age group, or let's say 65 to 75, and I'm thinking, wow, all of a sudden I start kind of going through that mental Rolodex in my head. I'm like, wow, are they struggling with something like that? Because let's face it, you work your whole life to kind of own your home and whatnot, and then to be facing this where you're like, man, I'm house poor. I can barely survive.
Well, exactly right. And, I think the sort of the about reverse mortgages is, it's a product that a senior homeowner would use where they've owned their home a long time. Maybe it's free and clear, and it's a vehicle to pull cash equity out of the home. And so the thinking is, in most cases, it's to pull that cash equity out because it needs to be spent on something, improve more income, because the homeowner is cash poor, income poor, but has all this equity that's trapped in their home. But again, an alternative scenario for a reverse mortgage that can be very effective, very powerful, and can really help a senior homeowner is the kind of situation we're talking about now. Because, and again, using the example of what I'm working on now, again, the value is 1.1 million. She owes 371,000. She's 74 years old. Of course, you go, how did she end up in that situation? My guess is, because we haven't gotten this far yet, she probably maybe owned the home with a spouse. Perhaps the spouse has passed on. She's on a fixed income. Maybe the spouse was working, or maybe was retired, but maybe had worked in a career where there was a lot of income coming from retirement and so forth. So you always wonder about how did the homeowner get into that situation. But that being said, the reverse mortgage option can be really a lifesaver to address that problem. Now, in her case, when we have a a software product where we can plug in the parameters of a situation, a homeowner like this, and provide them some options. So I did that with this lady. She was born in February of 1952. And again, 1.1 million value. We always have to get the zip code because that has a bearing on what kind of loan amount you're going to get based on where the property is located. Now, in this case, she's in Orange County in Anaheim. 92804 is the zip code. And again, the $371,000 loan with a $3,000 a month, PITI, housing expense all in. So the results that we're able to present to her actually are four, not one, four different reverse mortgage products.
Oh, wow.
And of course, you might think, well, gosh, why would there be four? Well, one of the things about the reverse mortgage industry is it's evolved over time. Reverse mortgages have been around since the early 60s. And the core product in the reverse mortgage world is what's called a HECM, home equity conversion mortgage, and it's an FHA product. But in recent years, the industry has developed what are called proprietary non-FHA, non-government insured product to address the additional needs that a lot of homeowners have that the core HECM product maybe isn't, adequate to resolve the issue that they're trying to address. And so what's interesting about this is I've got four different options to present her. And they vary depending on what kind of benefits they provide. For example, the HECM, that's the product you're going to get the best rate. It is a variable rate product, so it isn't adjustable. It's going to give you the best rate because it's an FHA product. So the loan is insured. And of course, the investors who invest in bonds that are secured by this, these loans, you're able to get a better rate on the loan because it's insured. So the investors are protected. Now, what this loan will do, based on her age and the property value, it'll pay off her mortgage in full. And she'll get about $43,000 of additional cash that she can access.
Okay.
That can make a pretty significant change in her household budget because now suddenly all of her fixed income isn't going to a mortgage payment. Now, there are other options. We have what's called a home safe standard and a home safe intro. Now, these are proprietary products, which actually you can be eligible for at not 62, but at 55. But again, using her scenario, now the rate's higher. And these two, home safe standard, home safe intro, are fixed rate product. You get all your money at once, lump sum, and you're done. Now, these also will provide a loan amount great enough to pay off her current mortgage. No payments. But they give her higher cash access. $117,000 on one of them and $150,000 on the other.
Oh, wow.
But again, you get the cash part lump sum. You don't get to keep it in a line of credit and draw later. You get it all at once. But obviously, if you can get rid of $3,000 a month, and you could potentially get $150,000 in your pocket as well, that can be pretty compelling. Now, trade-off, rates higher. $895 on one of them. Again, fixed rate. Home safe intro is 9.5. So again, but that gives you even the $150,000, not the $117,000. So there's trade-offs. And then the last one is what we call home safe select intro. That's rate also about 9.625. It'll get a similar, about $144,000 of proceeds, in addition to paying off the existing mortgage. And it's a variable rate loan. It's not a fixed. So the point is, I can provide all four of these options. And so part of the process will be going forward is we'll sit down with that borrower, walk them through all of these in detail, because what we're trying to do is not make the decision for them, but help them decide which one of these is going to best be suited to solve her immediate needs.
Well, Art, the thing that comes into my head is okay, now here's a 74-year-old individual who probably was looking at all our options and thought, I have none. I just have, maybe the only options he had was sell my house and move in with my kids or something, God forbid. And yet now you came in with a different set of eyes and understanding, and now she has four options, and none of these sound bad. They all sound great. I mean, even the one with the lower interest rate, the lower out was at like $40,000. I mean, that's a whole complete reversal, because now it's $36,000 a month that was going out is coming in, plus another $35,000 or $40,000. How good is that? I mean, that's got to be why you do what you do.
Well, exactly right. Because see, the idea there is, because what we don't know yet about this particular prospect is, how much other cash does she have, like in the bank? Because she could very well be in a position where her income is fixed, Social Security probably, and maybe some other stuff, but it's probably not much more than what her housing is at this point. So that would necessitate that she would need to be pulling cash from another source just to live on. And the problem there is, 71% of seniors are worried about running out of money before they die. Well, the problem here in her situation is, in particular, if she doesn't have a lot of cash assets, and if she has been relying on that to live on because of her high housing expense and fixed income, she is going to run out of money. And so I think that's why in her case, she's realized, I've got to look at some options. And, thank goodness, we have multiple options that will definitely address the problem, solve the problem for her. It just becomes an issue of what's the most important feature. You want the lowest rate? Do you want the highest amount of cash out after you eliminate that mortgage debt that you desperately need to escape from? Do you want a fixed rate, or do you want a variable? So these are all parameters that aren't obvious as to which one's best at first glance, but that's part of our role, again, is to go through all those options and help the borrower decide which one is going to be best long term, so that they can live comfortably. They can be assured they're going to have enough cash assets as well as income to live on, and not be getting back into that period or that point of desperation where you go, oh my gosh, I'm going to run out of money. So that's why this is a very, very, very good example of, not somebody's free and clear and they just want to get 500 grand out because they want to do a bunch of stuff. No, they have an immediate need to eliminate debt. And the biggest debt she has is obviously probably her mortgage payment. And again, this is going to be, I think, very helpful to her to solve that problem. And it kind of reminds me of my dad's situation from 20 years ago, actually. So.
Well, I mean, as you said, you just kind of left me hanging. I felt like a Netflix show. Tell me about your father, because maybe somebody hasn't heard that, because I think that is exactly what a lot of people are facing.
Well, yeah, my dad's case is interesting, and I think it's more common than folks would admit. So for anybody watching, especially if you're not a reverse mortgage candidate now because you're not old enough, but if you have somebody in your family who is, what I'm about to describe with my own father might sound familiar. He bought a home in Fontana, 1979, brand new home, or not 79, 1999, brand new home from Presley. And it was in Fontana. I think the base price was around 130. Wow. And after upgrading it a little bit and so forth and so on, it was 170. That's what he paid for it. Well, fast forward to the mid 2000s, around 2005, 2006. And I'm talking to him one day, and I learned a couple things. First of all, in the home that he bought from Presley, I arranged the mortgage on. It was at the time, mid 2000, 2005, 2006. It had a balance of about $125,000, and he was paying just under $1,000 a month to cover that mortgage. But then, and he was kind of complaining about the fact that things were tight for him. Now, he was self-employed most of his life, so his Social Security check was not very high, because as a self-employed person, oftentimes you're not paying yourself a salary, so you don't have that to help beef up your Social Security benefits once you retire. He did work for a couple of companies briefly, and he had a very like $150 a month pension check from a company. And long story short, he was getting about $1,800 a month in income. That's all, again, he was on a fixed income. And then half of that, more than half, was going to this, what we would consider a modest $125,000 mortgage. Well, then on top of that, what I found out, he was paying extra on the mortgage.
Oh my gosh.
And I said, well, Dad, okay, I've heard you kind of grumbling about how things are tight. You're having to pull money out of your investment account to live on. And yet you're now admitting you're paying extra on your mortgage. Why would you do that? Well, his explanation was, in his mind, logical. He said, well, I thought it's a good idea. I should do that so I can build up more equity so that you guys, meaning the kids, me, my brother, my sister, will have, access to, equity to, help take care of me when I get old. Now, mind you, at this time, he was 80 years old.
Okay.
So I was like, well, Dad, you're working at cross purposes here. You're complaining about not having enough monthly income to live on. You're having to tap into your investment account. It was a pretty modest account. It was about 300 grand as those things go. And then you're using more of your assets to pay extra into an asset that is illiquid. So yeah, you're building more equity, but it's not going to be easily accessible, particularly by your kids, us, because it's in the home.
Yeah.
So that's what led to the discussion I had with him about, you got to consider a reverse mortgage. And of course, like all senior homeowners, including my own father, a lot of misconceptions. Oh, no. I don't like that idea. That's just bad. And so I had to work through all that. But once I did, here's what we ended up doing. The timing was perfect, by the way. 2006, the peak of the market in terms of home values.
Yeah.
Well, that home at that point, only 7 years later, appraised for $445,000.
Holy smokes.
He had purchased it for $170,000. That allowed for, based on his age, he got a reverse mortgage for about $250,000, more than half the value, which today that wouldn't happen because the amounts you can get have been cut back for other reasons that we'll talk about on another show. But so he was able to get $250,000. The first thing that did is paid off the current mortgage. That saved almost $1,000 a month in his mortgage payment. And of course, he had half the loan left over. And he used the HECM reverse mortgage, the standard FHA HECM product. And with that, the money you have left over, you can access it in a multiple of ways. You can get a monthly check for life.
Oh.
You can get a monthly check for a specific period, like 10 years or 20 years. You can set up the remaining amount as a line of credit to draw on as you wish, when you want. Or after a first year, you can just take the lump sum. Well, in his case, he took lifetime payments.
Wow.
So he was receiving almost $1,000 a month from the reverse mortgage. Also eliminated that $1,000 a month on his existing mortgage that was paid off. So that was a $2,000 a month swing in his household budget income. And so as a consequence, he was relieved beyond description.
Can't even imagine.
Yeah, it was a big, weight off his shoulders. He was able to be much more comfortable. And he continued to get that check for 14 years.
He lived till 94.
In fact, it was 6 years ago this week, actually, that he passed. And but that is a good example of how homeowners in this trap of, I own a home, I've got a lot of equity, but I got a mortgage here that's getting a little painful to deal with. And I don't have a lot of extra cash, either in terms of monthly income or even in the bank. What's the solution for that? Well, what I just described certainly solved his problem, my father's problem. And this is, again, the same kind of approach that we're going to use with a prospect that we're dealing with right now, because it is a good example of how a lot of senior homeowners have mortgage debt that they really do need to get rid of because they just can't handle it anymore because their income has changed. and it's becoming a real financial burden.
Well, it makes me wonder. Your father, who knew you were a lender, a mortgage broker, and was resistant against the whole idea of a reverse mortgage. I'm wondering, like, how many pockets of these senior homeowners in that similar situation, like the one you're working with right now, really exist. And they're 74 years old and they're thinking, can I get a loan to get out of this? I'm 74, don't have a job. Basically, my income is almost exceeded by my debt. I can't get a loan. How can this happen? And maybe for those people that have never heard of a reverse mortgage, tell us what you have to do to qualify for a reverse mortgage.
Well, that's an excellent question. And the good news is how you qualify is much different than a traditional, what we call forward mortgage. You're not qualified for a reverse in most cases based on your debt to income ratio.
Okay.
It doesn't work that way. Now, you do go through what's called a financial review, a financial assessment, where you are going to provide income documentation on your money in the bank, whether it's checking, savings, retirement, stock, bonds, mutual funds, whatever it is. Now, they're going to look at what your potential loan amount is, what it's going to be used for. Of course, in this case, with this particular prospect that I'm working on, it'll get rid of her $371,000 mortgage, and therefore the payment that goes with that $3,000 a month. Well, if it turns out her fixed income is in that similar range of, say, $3,000 a month, getting rid of that mortgage payment, of course, is a big step toward meeting that financial assessment review and getting approved. Now, again, they're not going to take that $3,000 a month and calculate a debt ratio based on other monthly payments she might have for car loans or credit cards or whatever. Instead, what they're going to look at is the monthly income, the fixed income, plus the money the borrower has in the bank, will that be enough to handle the monthly obligations that they will have, any consumer debt, as well as property upkeep and maintenance and expenses like taxes and homeowners insurance. And then all that's evaluated, and what's calculated is not a debt to income ratio, but a residual income amount.
Oh, okay.
That varies by family size. So in her case, if she is a family of one, she has no one else with her, or maybe no spouse has passed away, what have you, then based on the location of the property, there are residual income charts that are used for reverse mortgages to say, okay, for a family of one, the residual income has to be at least $750 a month. So that's the calculation that is done, and it's much more, it's much easier for the homeowner to, get approved for the financing based on that approach versus the standard traditional debt to income ratio for a forward mortgage. And so that's the way, because in her case, you get rid of, if you're making $3,000 on Social Security and you're paying $3,000 for a mortgage, you get rid of that mortgage. Well, suddenly you're in pretty good shape to meet that residual income requirement because you eliminated the biggest chunk of what was keeping you from meeting that requirement. So that's a good example of how this can work very well. You don't have to fret about, I need to have a job making $80,000 a year. You can qualify without a job just based on those parameters I just described.
Well, I think one of the questions our audience, your audience, would want to know is, hey, who's an ideal candidate for this and who is not?
Well, I think the answer to that would be certainly any senior homeowner who has mortgage debt that would be deemed to be a relatively heavy burden when you consider their overall financial profile, meaning, what their fixed income is, if it is a fixed income, and how much they have in terms of liquid assets. If they are light on both of those, then this reverse mortgage strategy is perfect, I think, for that type of homeowner. Now, you can have another homeowner who could be that age or 80 years old, and they can own a home that could be 2 or 3 million, and maybe they have a $500,000, $600,000, $700,000 mortgage on it. But if they're if they're on a fixed income, but the fixed income is much higher, like for example, maybe they were an ex local, state, federal employee with a pretty hefty pension, or certain job categories like firemen and police who can retire in very hefty pensions, that kind of thing. And then combine that with if they've got a substantial amount of liquid assets, then that, some of which are probably throwing off income, interest, dividend income, and so forth, capital gain income. That's the kind of senior homeowner where this strategy really isn't relevant to them. They can financially manage that, fairly high mortgage that they have. So for that type of senior homeowner, the reverse mortgage would be looked at not so much as solving a debt burden problem, but a reverse mortgage would, in that case, the higher net worth homeowner who maybe has significant income, in that case, the reverse mortgage is going to be looked at more as a financial strategic tool, in terms of how they can use the proceeds they could get out of a reverse mortgage in certain ways, which could include more investing and so forth. So you really have to look at the kind of overall profile of each homeowner. And again, the ones that are really light on income and liquid assets, this particular strategy we just described is perfect for them.
I put your phone number up there, 760-969-5023. Is that something that if someone's listening to this, or they have let's say an older parent or parents, and they want to know more about this, is this something that they call you and it's more of a counseling session to find out, hey, are you a good candidate? Is this a good idea?
Well, yes, because, and again, I keep bringing up this prospect we're working on now. What I do is I start off like, we got to get on a phone call, and I have to ask some questions to get a basic understanding of the parameters of the situation. And then once I know all that, then I always recommend we can put together a proposal package for the homeowner that's going to lay out these options. The 4 options I just described earlier, they will be part of this proposal package. Now, the package itself can be a little bit intimidating. Believe it or not, once it's created, it can be like 100 pages. Now, about 60 of those pages is the back end of the package, where attached is a consumer handbook that HUD has created to go over all the nuts and bolts about how a reverse mortgage works. But the first part is where the program options are presented. There's detailed numbers to show you how the numbers work in terms of your equity position, how that changes over time, estimates of how your property value is going to appreciate over time, what each program is going to give you in terms of interest rate, proceeds, and so forth. So the next step is I'll create that proposal and I'll send it to the prospect. And then I'm going to recommend that we have a meeting of some sort, whether it's on the phone or we get on a Zoom, or quite often I actually suggest, let me just meet with you in person. You can come to me or I'll go to your house. And in a lot of cases, the inquiry comes actually not from the senior homeowner themselves.
Oh,
it
really?
comes from their trusted advisor, as we call them, or which oftentimes is a relative. And in this particular prospect, yes, the person who inquired is inquiring on behalf of what he described as his mother-in-law. Oh. And of course, and when I got into all right, I'm going to put together the proposal package, he then reiterated that he and his, I guess, wife are helping her evaluate this option. And so the implication is that when we have that discussion, it's probably going to involve all 3 of them, the senior homeowner, the son-in-law, and his spouse, because that's an important part of the process. The senior homeowner needs to be comfortable that they're being steered in the right direction, because again, there's so much misinformation about reverse mortgages. Again, just the other day, I had someone repeat again this falsehood that, when you get one, doesn't that mean the bank owns your home? So with all of that misinformation still out there, it is vitally important that once we get to a proposal stage, that package needs to be reviewed in detail, carefully, slowly, in plain language, with not just the senior homeowner, the borrower, but any trusted advisor or advisors that they have who are going to be kind of looking into or looking over this process if they pursue it. So then I really want to talk to all of the folks involved so that everybody's on the same page and everyone's comfortable that this really is a very, very good, option for people in this situation.
Well, last question. Give us an idea of time frame on this, because it almost sounds like, especially in the situation you're describing, it's like sooner rather than later for this particular homeowner out in Orange County.
Well, yeah, I mean, in this particular case, with that kind of burden, yeah, you want to pursue this sooner than later. Again, the big stumbling block is the anxiety and the hesitation and the worries about misinformation that homeowners hear that are really kind of make the reverse mortgage seem like an evil product intended to somehow steal your home away from you. And it's really sad because that couldn't be further from the truth. So in terms of timing, the biggest part of timing, when we originate a reverse mortgage, the whole life cycle of first contact to closing is entirely different, because there's a whole lot more hand holding and explanations and walking through scenarios and loan estimates and so forth. And that takes a lot of time. And even after you do that, then you got to wait for the prospect to kind of let it all sink in and then decide if they want to move forward. So just the whole sort of sales process, I guess you want to call it, is going to be longer. We usually recommend for reverse mortgage, plan on a 45-day escrow period, not the standard 30 when you're getting a mortgage to purchase a home. And part of that is because of allowing more time to really get the homeowner up to speed and feeling comfortable. And then structurally part of the process, early on after you get this proposal package that we send out, your first step, if you want to move forward, is you have to schedule counseling. That's usually done by phone. It's pretty inexpensive. It's $150, $200. It usually takes about an hour, but you have to do that first. And then we have to wait 7 days, a 7-day cooling off period, before we can take next steps like pull your credit report, order your appraisal, get your file registered with the lender and so forth. So for that reason, plus just the overall complexity of the product, you've got to plan on a longer escrow period. So.
Well, 45 days is not that long when the prospects in this situation for this gal, for this woman is four very good options for her. And right. I think that sounds good. Well, Art, again, I've got your number on the screen, 760-969-5023. If this sounds like something for you or someone that you think could help them out or you out, I encourage you to call Art right away and start that 45-day process. I just want to ask one last little thing, pull on this. You said about the counseling thing. Is that just one more safeguard to make sure the homeowner really understands what's going on?
Yeah, absolutely. One of the things about reverse mortgages is there is a high level of focus on making sure that senior homeowner is not going to end up getting subjected to any kind of misinformation. Frankly, just to use, one of the things we're trying to watch out for is you don't want any inkling of any sort of elder abuse where a homeowner is being, directed toward this kind of product for means that are not honorable. So, in the old days, reverse mortgages were highly criticized because there was not enough safeguards to where unscrupulous loan originators would go after a senior homeowner and kind of twist their arm to take one of these products to pull a bunch of money out and then get it allocated over to some financial rep who's going to put it into a bad annuity and ultimately end up with a bad financial outcome. So there's lots of safeguards to make sure that senior homeowner is fully aware, fully informed, and completely comfortable with doing this, pursuing this product, or it's not going to happen because it's just not worth it. So that's the other frustrating thing about the reverse mortgage is it is actually a very safe product. The process is designed to make sure you're not going to get into something you don't want, and yet people are still very, very afraid of that. that product. And of course, part of my goal and mission, as long as I'm doing this, is to help people realize that's not the case. And this is a really good option that a lot of folks need to look at more often.
Well, Art, thank you very much. I'll turn it back over to you, and I appreciate this explanation. Really good stuff.
All right. Okay. Thanks, Jeff. I want to thank all of you for watching and listening to this week's Mortgage Minute. If you or anyone you know are in a position where a reverse mortgage could be of help to you, like in the case we talked about today, where maybe you have a fairly large mortgage and a mortgage payment you'd like to get rid of, and you've got equity in it, and you are of adequate age to be eligible for a reverse mortgage, give me a call. Let's have a conversation. No pressure. I'll be happy to answer some questions, maybe give you some numbers, including a proposal, and see if it's going to be something that'll help ensure that in your senior years, you're going to be able to live comfortably and enjoy your years, and not have to worry about the burden of too much debt, and have the income to enjoy your living style as you go forward. So again, thank you everyone for watching and listening to this week's Mortgage Minute. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So long. Take care.